Hello, Dr. Harris. My name is Gladys Gutierrez, and my co-manager is Hannah Levine. And we will be talking about our performance in the business strategy game and some of the lessons learned and trends that we learned from the business strategy game. Our initial competitive strategy was to minimize costs by spending an optimum amount of manufactured shoes and maintaining an SQ rating of 4, and that would also help customer satisfaction by optimal savings for them. Our initial ratings or ranks for the game from years 10 to years 15 weren't as good as we expected. We didn't meet the goals of the investors, but as we started to get the hang of the game, we started to do better and we started to meet the investors' expectations. Okay, and now I will talk about some of the trends that we noticed from our total annual revenues, earnings per share, return on equity, annual credit rating, the year-end stock price, the image rating, the branded and private label footwear, and the global market share. Okay, and to start off with the total revenue, the first couple of years were kind of low or not as well as we expected. And as you can see, years 10 to 11, there was a slight drop from years 10 to 11, and that is because of the advertising. It was way lower than everyone else's advertising. And in the following years, we increased our advertising expense by 13 million. And from there, we saw a huge increase in revenue. Okay, and now I will talk about some of the trends that we saw for the earnings per share. Okay, now, and as we all know, earnings per share is the portion of a company's profit allocated to each outstanding share of common stock. Earnings per share serves as an indicator of a company's profitability. And the first couple of years, from years 10 to 14, we didn't meet our expectations. Our numbers were slight low. And in year 15, we gradually managed to increase our earnings per share by a great amount, exceeding the investors' expectations. And we did this by borrowing extensively to purchase and build capacity. And this capacity expansion led to our growth from years 16 to 18. Another very important factor that helped increase our earnings per share was that in year 16, we started to pay out stock dividends, which we started out paying low and gradually started increasing that price. Okay, and now I will be talking about some of the trends for the return on equity. And the return on equity measures a corporation's profitability by revealing how much profit a company generates with the money shareholders have invested. The return on equity is useful for comparing the profitability of a company to that of other firms in that same industry. And as the chart portrays, we didn't meet our investors' expectations for the return on equity until we reached year 15, and that is due to the fact that we didn't have enough capacity for our company. But starting year 15, we gradually managed to expand those numbers. And now I will be talking about the credit ratings for our company. Okay, and so credit rating is an assessment of creditworthiness of a borrower in general terms or with respect to a particular debt or financial obligation. So it is basically what a bank or financial institution looks at if a company wants to borrow money. And as our graph indicates, we maintained a pretty good credit rating from years 10 to 20, unless year 11, and that is, I believe, because we made a mistake of selling all of our capacity, and that made it really bad. But we went up pretty good because we did borrow some amount, but we paid all of our debt in time, and that also allowed us to keep our interest rates quite low. Okay, and now I will be talking about some of the trends for our stock prices. Supply and demand in the market determines stock price. The price times the number of shares outstanding is the value of a company. Earnings are what affects investors' valuation of a company, but there are other indicators that investors use to predict stock price as well. And as I had mentioned previously, also what helped increase our stock prices were the dividends paid from year 16 that we were paying to investors that helped to increase our stock price increase. Okay, and now I will talk a little bit about the image rating for our company. And we never managed to reach that ranking of 70. We were always low, and that is because we didn't have any celebrity appeal for any of the years, and we also didn't work on any of the corporate or social responsibility. And that is due to the fact that it affected our earnings per share and return on equity values. And so we thought it wasn't worth it messing with the corporate or social responsibility, because it wouldn't increase our image rating that much higher, but it really would lower our earnings per share and our return on equity. Okay, and now we'll talk about the branded and private label footwear. And as the chart indicates, we only invested on year 10 for the private label. And that is because another team, I believe it was Team D or one of them, pretty much killed it. They did very well, and there was no way we could meet or beat that expectation. So since we couldn't compete with them, we just decided not to invest in the private label sales. So by increasing to 499 models, that really helped increase our global market share. But if our internet price was 40% higher than the wholesale price, the global market share would have been much higher. Our wholesale segment market share was at 13.3%, and the internet segment market share was at 16.4%. So we could have increased our internet segment in order to increase our global market share.